listening to What the Truck.
Are you ready to truck in? It's time for your 11er with Dooner. How's everyone doing? Where are we? We're supply chain meets FinTech. No, this isn't a B movie. This is actually a really prescient event. I mean, if you guys are paying attention over the weekend with SVB, there was a huge collision that almost happened with FreightTech and FinTech and banking. We'll get all into that. First, we got to do a little housekeeping here. Thank you, everyone, for coming to this event. I'd like to thank the sponsor of this entire show, which is ZenHedge, the What the Truck show sponsor, which is Triumph Pay. It's their lovely logo right behind me. There's a prize today. If you haven't registered, if you're watching this on one of our other channels, you can win a Yeti Roadie. All you got to do is go to live.freightwaves.com and you'll win one of these things right here. I'm not even sure what one of those things does. If you win one, DM me. Let me know. Also, we got some other virtual events. So while you're at live.freightwaves.com, also register April 5th for our 3PL Summit and April 26th for our Small Fleet and Owner-Operator Summit. I'll be there. Will you? I don't know. We'll find out. Let's take a look at a number of the day before we get into things here. This, my dear friends, is a McDonald's hash brown. It is $3.09. Getting pricey, is it not? A processed piece of potato right there. Now, let's take a look at the national spot rate. Throw this index up right here in Sonar. That's $2.37. That's right. We are down below the hash brown line, people. Hash brown's 309. Spot rate's 237. This is not a good thing. In fact, Travis Winnan says baseball has the Mendoza line. We have the McDonald's line. Ed Bird says, does this mean HPM, hash browns per mile, is now an appropriate measurement for trucking? Could be onto something. Gregory Bonilla, he's got a finance degree. He says, wow, at first glance looks funny as hell, but instead, this is really effed up. Hope those spot rates are back up shortly. Nicholas Haywood says, the best I can do is a McDouble and a large Coke per mile. And Paul McClellan says, can I supersize that spot rate, please? Absolutely. These are our listeners. Thank you, folks. Anyways, on the show today, did FreightTech almost experience an extinction level event? FreightWaves editorial director Rachel Premack has the latest on what happened with Silicon Valley Bank and how it may have impacted freight. Speaking of RICS, we have ZenHedge CEO Krishna Kandasamy. He's talking about mitigating freight transportation risks in a post-pandemic world. Triumph Pay's EVP, Chief Commercial Officer, and Chief Relationship Management Officer Dan Curtis, he breaks down the rising interest rate market and shares how to help brokers. And we got the ComFreight HaulPay founder and CEO, Steve Cochin. He's going to discuss transportation, business, finance, and credit risk in a challenging market. But you know what? Rachel Premack's here right now. So what are we waiting for? Let's bring her up, editorial director at FreightWaves. Rachel, what's going on? You bought any hash browns lately, or are you taking out any high-interest loans to buy them?
No. Although I do love hash browns. I think they're my favorite side at McDonald's for sure.
Do you think we're onto something with the Mendoza line being just the cost of a hash brown? Is that a good cost of living indicator on where spot rate should be?
So it's a really interesting indicator to pick because there actually is the Big Mac index that economists, kind of informally use to track, cost of living in certain areas, just in countries around the world. So a Big Mac in Sweden, for example, costs way more than a Big Mac in the US. A Big Mac in the US, I would imagine, costs a lot more than one in India. I don't know if they serve Big Macs in India because that's cow, but that's a whole other story. So I think you're onto something by using a McDonald's item.
Yeah, I think that there's some traction there. We almost might not have needed any more Sonar charts. I mean, the whole entire FreightTech scene, and I didn't realize this at first. You hear there's a bank failure happening, right? And you hear SVB, and it's like, oh, that's horrible. Probably has nothing to do with me. What's going on with this thing? Well, then very quickly we realized it might have a lot to do with not just us, but a lot of people in the FreightTech community. What happened with SVB? I think that was Thursday. This all started to fall apart.
Yeah. So SVB, not a household name, but it actually has 4 decades of history with backing VC firms and startups, and even being that key bank for a lot of tech employees in the Silicon Valley area. And over the past week, it just kind of became clear that this bank was not doing well. This kind of stems back to, you could say it's a low interest rate phenomenon. They started buying lots of long-term treasury bonds in 2021. when interest rates started to climb back up, the values of those bonds decreased. The borrowing rate became so expensive that a lot of SVB clients started to pull their money out. And it all kind of reached a crescendo last week, and the federal government officially closed SVB on Friday, which sparked a lot of concerns across the entire startup community, including in our own freight startup world.
Yeah, the first indicator I saw on that, and there's been some interesting follow-up, but it was Ryan Peterson from Flexboard, and he just tweeted out bank run. And I'm like, man, what does that even mean? And it's funny because that story has progressed, because the Lodestar, they published an article saying that that Flexport was probably most definitely a banker with SVB, and they're like, no, we didn't touch that stuff at all. But a lot of freight tech companies did. Who was in the line of fire? Who was in trouble? Because the most immediate thing that happened was everyone was like, oh crap, how are we supposed to make payroll?
Yeah, well, the one big company I can think of, and I can say this publicly because our CEO was talking about this on CNBC, is FreightWaves. FreightWaves was an SVB banker. It turns out all of our money is safe. We're good. But it is certainly something that was certainly concerning to, I imagine, quite a few of these freight startups.
So what was happening in the back end? I mean, we heard Craig talk about this, and I know on our side, we had to do the thing that you're always most thankful for. And I think Craig said something to the effect, and I'm paraphrasing here. A board doesn't really matter in good times. What you really want is a board that can pick you up when you fall down, when you have those near-death experiences.
Yeah, so I think this is definitely a key issue we're facing here. I've been thinking, there's a lot of freight startups that I imagine aren't, about to collapse, about to, be wiped out, but they're not exactly thriving right now. And if their investors, if their board kind of thinks, maybe this one's not worth saving, maybe this other one's more worth saving, that could be the end of their company, even if they're not, exactly about to collapse, right away. But sort of the acceleration of this could have happened as a result of SVB. But as we know, the bank was not bailed out, but kind of bailed out, in the last week. So perhaps those sort of major collapses are not going to happen.
Well, I mean, what does this mean for the space and investing in this space? It was already kind of challenging to go out and get funding, and the deals weren't as frothy as we'd seen in previous years. And this is before the bank failed. So what's that going to mean for 2023? I'd be pretty scared right now if I was trying to raise my Series A.
Yeah, I would say it's not the best sign. I think in general, this is a kind of a poor indicator for the health of the U.S. banking system. We've already seen Moody's actually decrease their rating of U.S. banking as a whole. So it's definitely not a favorable time for companies that are looking to raise funds or even just, up their line of credit, essentially.
Are we out of the woods yet? Or are there going to be more failures? I heard yesterday Bank of America saw billions in extra deposits as people pull from regionals to big ones. Do you think we stop the domino effect here? Is this only going to get worse?
It seems that these regional banks are especially hurt by what's going on here. And I think what also needs to happen is just looking at what sort of regulations do we have on these regional banks. And taking SVB, for example, yes, that was a regional bank that managed to get out of some of these regulations that were passed, especially in the wake of the 2008 financial crisis. But obviously, SVB is doing business with companies that aren't exactly, a mom and pop, five and dime store on the corner. Banks like SVB are backing some really major companies and backing companies all over the country and all over the world, in fact, in SVB's case. So I think looking a little bit more closely at what sort of regulations do we have on these regional banks? Are they as stringent as they should be, considering some of these do have a really major impact outside of just their own little region? I think that's a really key next step for the U.S. Political sector to really look into.
The main questions I keep hearing is, herpa derpa, doesn't everybody know, deposits are only insured at $250,000. Any bank you walk into has the sign. Well, what about payroll? Like, where do you keep payroll? Where do companies keep money liquid? But do regulators need to step in? Because one of the things that SVB was doing, as I understand it, is they wouldn't allow you to remove a lot of that risk because they forced you to do all of the banking through them. So even if you wanted to put this money elsewhere, you did not have that option.
Yeah, suddenly in the last week, everyone is an expert on SVB and all banking regulation. Like out of nowhere, everyone's like, well, don't you know that this bank had this, this, and that problem? And it's like, did you know that? Like, have you heard of this bank before a few days ago? But yeah, definitely, I think payroll was really the key issue for a lot of these companies that were banking with SVB, because today, the 15th, it is payday.
Yeah.
So, and it was not even a week ago that this bank was starting to really collapse and starting to disintegrate. So if you can't make payroll, I would maybe not be so happy with my employer if I was not getting that key sort of part of the employment agreement.
Ask those Slink employees from last year about that.
Yeah. But as of Monday, the federal government said that all SVB depositors have been able to access their funds.
Okay.
So,
well, Rachel, before I let you go, I got to send you the wheel of stupid questions. So round and round it goes. Let's see where we end up today. Ooh, I like this one. Okay. Can you say that you read a book if you only listen to the audio version?
Yeah, I think so. And I don't read audiobooks or listen to audiobooks just because I don't have a car. It's just, I don't know. I just prefer reading. I think you can say that for sure.
All right. That's a very progressive viewpoint. What if you watch like the movie? Does that count too?
No.
Okay.
No way.
Wikipedia article, does that count?
Movies are always so different from the book.
Okay. All right. Well, I like it. I wish you were my professor. Rachel, where does everyone go to subscribe to Modes?
FreightWaves.com/modes, or you can check me out on LinkedIn. It's just my name, Rachel Premack, or on Twitter @RRPRE.
Okay. Well, hey, Rachel, take it easy. Be good out there.
Thanks.
All right. Take care. All right. Meanwhile, let's take a look here. I bet she's got a good punch. Oof. He found out. Now, we talk about risk management a lot. What could this guy have done differently? Well, for one thing, he could have not stood in the line of fire. It's a dangerous position to be in. I know it seemed highly unlikely that her aim would be so poor that she would miss the bag here and hit him directly in the face, knocking him over a movie sign. But things can happen. That's why we mitigate risk. Anyways, I don't know. I feel like those things always cheat. It never says I hit hard enough whenever I whack those things. I bet our next guest could tilt one of those, though. It's Christian Kandasamy, CEO at ZenHedge. Christian, did I say that okay?
You did. You did a pretty good job.
I think so. You got a good punch.
Well, it's always about anticipating where the punch might land. That's the critical thing in risk management. And he was standing too close to the firing line, in my opinion, as a risk manager.
Yeah, I sure do. I mean, how did you get into risk management to begin with? And I know it's kind of your CEO, but you still define yourself as a risk manager. What is like your origin story here?
Yeah, so I have a background in finance and risk management, predominantly in commodity hedging, price risk management. And one of the things that you learn in the risk management phase is you try to protect the downside. You don't really worry about how much profit you're going to make. You worry more about, how much losses can you stop. And in that way, it is actually helping making your business sustainable, continue to grow. So I got into this space because of the fact that I found out that a lot of big companies, small companies, have really difficulty managing, understanding, mitigating risks. And it's partly a fault of, the acronyms and the jargon that is used in the risk management world. But ZenHedge's goal is to make things simpler and transparent and help those companies that really do need a risk management solution be able to use it.
So before we dive too deep into this one, you said something really interesting there, and it almost sounds like you have the impression that a lot of people, when they're thinking about risk management, they're not thinking about enough. They're thinking about too small categories when there's broader things. Can you go a little deeper on that? What are the categories that you think they're thinking too much about, and what are the ones they're not thinking enough about?
Yeah, that's a great question. Not to beat up on SVB, this is a 40-year-old institution that was bankrupt in 48 hours. Okay, so I think the simple way to explain why that happened is lack of proper risk management. Potentially, their risk manager should have found out what was happening and taken some actions against it. A lot of times, what we notice is businesses focus on way to mitigate risk in a purely operational way. Maybe they may make a better in the context of freight world. They may think about optimizing the networks. They may think about using, the best carriers relationships, shipper-carrier relationship, or try to become the shipper of choice or carrier of choice. Those are some of the operational ways to mitigate, trying to reduce the downtime for truckers and so on and so forth. Those are some of the operational ways freight companies try to mitigate risk. They also look at technology, analytics, software platforms, digital platforms, TMS systems. Those are all technology way of mitigating the risks that are embedded in the transportation world. But they typically miss out on the financial ways. The only way they miss out, the only way they think about it is they think about it from a procurement budget standpoint, but they don't have an effective financial tool to mitigate that risk. And that is very critical in this post-pandemic world where things are changing rapidly. It's not just in case, it's a just in case scenario nowadays, not just in time. And you do need to think about the third leg that is really important for mitigating risk, which is the financial tools that are available.
It's interesting because now you hear, due to the first there was the capacity crisis, then there was the inventory crisis, and now you hear that a lot of those pandemic practices of going to just in case are falling right back to just in time because it's tough, because it looks better on the books. But this brings me to my next question. So what does the rerouting of global supply chains mean for someone like you? So it sounds like an easy thing to say. It sounds like an easy headline, but I met someone at your desk is like, oh, this means a lot of changes and it means a lot of risk.
It does mean a lot of risk because what you're looking at is, and I like to go to stores and figure out where they are manufactured, and I'm seeing increasingly new countries of origin being displayed in those products. What that means is supply chain is fundamentally changing. You may have heard the phrase onshoring, nearshoring, friendshoring, in that order. So these are some of the things that are happening, and what it means is that there are new partnerships need to be built, new trust bridges need to be built. That all poses risk for companies.
What about deglobalization? So that you kind of touched on that here. How does this change the risk profile? And conversely, not deglobalizing or not following in that trend, there might be some risk inherent in that as well, is there not?
Absolutely. I mean, this is a phrase that has come out, for the past few years, and COVID particularly highlighted it. How deglobalization we are happening, right? We are more and more companies, governments of the European companies and in North America are trying to reshore, bring back manufacturing to the country. What it means from a trucking side of things is that you're going to have more need to inland transport, right? So that means that there is also going to be potential repercussions on the trucking world. There may not be as much linkages between ports and inland. It may be more inland and manufacturing centers to distribution centers. So the rerouting of that is going to be a significant risk that is still unwinding. It's still happening right now. So we're still in the middle of it.
No, yeah. I mean, it's impossible not to talk about these subjects with obviously something like SVB coming up. And you mentioned it's 48 hours, right? But it's even quicker if you're in that heat of that moment, because once the word starts spreading about this, all the systems lock up, right? You can't get through customer service. You can't get to your money. It may as well be like 10 hours. So with that in mind, does the world need more rapidly responding risk mitigation tools?
Absolutely. I think that's some of the things that we develop at ZenHedge is solutions that not only tell you how to prevent risk and how to help you with the risk, but also makes you whole. That is one of the things. A lot of the solutions that we talked about from a technology standpoint or an operational standpoint don't give you cash payments for if something goes wrong. At ZenHedge, we are developing solutions, particularly an insurance solution that can help companies that are facing supply chain disruption, either in the trucking world or the transportation side, to make them whole on whatever that disruption happens. And the main thing that we look for in these companies is that, like you mentioned, last year it was shippers who were in trouble. They were talking about budget overruns and things like that. Now it is carriers, right? So are you going to tell me that the shippers are not going to have problems few years from now? Absolutely, they are going to have problems again. So this whole cycle of risks that are getting transferred from shippers to carriers is happening all the time. And guess what? There are companies going bankrupt because of that slashing of risk and slashing of prices. And at ZenHedge, what we want to do is provide solutions for both shippers and carriers so that they mitigate that risk, that risk of higher volatility in freight rates, the risk of tender rejection. Those are the ways that we try to mitigate it.
So how does it work? So I insure what am I like? Walk me through the process here. So I've got a load, and now what am I doing with the ZenHedge? Okay,
so let's assume you're a shipper. You have a book of lanes, and you have a transportation budget that you are trying to meet. Okay, and let's say that the book of lanes that you have is closely matches a benchmark index that is already published. Okay, and because you are worried about prices going up, tender rejections happening, what ZenHedge can do is insure your book of lanes for certain trigger points that is linked to the benchmark. So, for example, let's say a shipper says, "Hey, I want to make sure that whenever the FreightWaves national truckload index goes above $2.50, I want to make sure that I get some sort of compensation because that increase in rates is getting reflected in my transportation budget. So I want to mitigate that risk." So they can buy insurance policies basically for their book of lanes and maintain their transportation budgets in a very transparent way. And therefore they can focus on other things like service quality or maintaining efficient operations.
Interesting. So like whenever it drops below that threshold, they make a claim to ZenHedge. How does that process work?
So we are talking about the carriers, right? So it's on the carrier side of things. So let's say a shipper, the index price goes, they bought a insurance policy for, let's say, $3 per mile, okay? And the index, the FreightWaves index settled at $3.05. They will get 5 cents multiplied by the number of miles that they bought the coverage for as a claims payment. So that way they are protected at $3 per mile. In terms of carrier, if the prices go down, they'll buy a policy which says, if the prices go below $1.80 per mile, and actually the index settles at $1.75 or $2.39 that you just saw, then the insurance claim will pay the difference between the trigger point that you bought and where it settled. So that's how you're protecting against the downside from a carrier perspective.
So is it all insurance now? Have insurance programs effectively and efficiently displaced risk?
Yeah, so, the insurance is one of those things that has been used in a lot of different areas to displace risk. And we talk about risk in the trucking world quite a lot, and there are a lot of ways to mitigate it, technology, operational, all those things have to be done. But in addition to that, insurance offers this elegant solution where you've done everything you can, but just in case, if something goes wrong, you have this additional layer of protection. Therefore, it gives you peace of mind. It opens up time for you to work on things that you have not prioritized as much. So that is the benefit of having an insurance that can help you.
Well, very interesting. Well, people who want to learn more about this, they want to connect with you, or they have any questions about what they heard, where do I send them to?
Absolutely. First of all, the insurance is not available for sale yet. So I'm not soliciting in this conversation sale of insurance. If they want to reach me, they can reach either the ZenHedge website, zenhedge.com, or you can also reach me via krishnan@zenhedge.com.
Hey, I really appreciate your time today. Thanks for coming on. Supply chain meets fintech, kind of like the werewolf meets the mummy or something like that.
Thank you, Tim. Really glad to be on the show. Thank you.
Take it easy. I appreciate that. Hey, our next guest. Before we get to him, by the way, got a new addition on the desk here. Got Bill Burr hanging out on the desk. That's the good thing about, like, this is why I got to get on like the Mandalorian or a Star Wars show, because they'll make an action figure out of any random character. So we got old Freckles right here, and it's a pretty good, accurate representation of his face. I wonder how Baldy feels about that. Anyways, it's Dan Curtis. He's EVP, Chief Operating Officer, and Chief Relationship Management Officer at TriumphPay. Man, Dan, how do you get anything done with all those titles?
It's a lot of words.
It is a lot of words. You're well educated. You're a Baylor Bear, are you not?
I am. Lifetime Texan. Just moved up I-35 my whole life.
So you must be sitting in the, are you sitting in like the Dallas HQ right now?
I am.
Wow. All right. How are things treating over there? For people who've never heard of TriumphPay, for whatever reason, what's the elevator pitch on your team?
So TriumphPay, we are working to automate and make more efficient the presentment, audit, and payment of carrier invoices. So we come into a broker and we will take over the back office carrier payable function, and we do that by lifting it out of their operation, handling it here with our team and with OCR, making cash available through quick pay programs that we expand and manage ourselves. And then we also create efficiencies within the back office by handling that operation in-house here.
Interesting. So what's the most exciting thing going on in that space right now before we jump into things over here?
So we are working in a network construct to automate that whole process by having hundreds of brokers integrate into our network and factors integrate into our network. That way, all of the carrier invoices that are presented from a factor perspective that are broker invoices, those can be verified, paid, all through the network in an automated fashion with no need for human intervention. So we've done about 1.2 billion of those payments we're doing about $24 billion a year in TriumphPay in carrier payments.
Wow. All about speeding up, getting people paid faster. Love to hear it. That is exciting. And, automation's all the rage in any space you go into, and no surprise you're hearing it in FinTech as well. It's the one thing people are always looking for on their freight is the money for it. Good to hear. So, but the one topic we hear about in terms of money, right, and we can't escape from, is interest rates. What is going on with interest rates? How are they impacting freight? How are they hitting brokers? What's going on there?
So in the last year, everyone's seen the Fed rate hikes, and it's almost 5 percentage points now in the last year, which is, it's been a long time since we've seen that. And the money was close to free for years before that. So in a brokerage, typically you're getting paid 15 to 30 days by a customer after you've paid the carrier. So you need access to cash. You're either going to have a revolving line of credit or an investment, or you're going to get an asset-based loan. And so as these interest rates rise, the cost of doing business for brokers has dramatically increased. And so at TriumphPay, what we can do to create cash is come in and manage a quick pay program whereby most brokers are offering quick pay to carriers if they want to get paid 1 to 2 days. We can take that over. We have over 40,000 select carriers within our network that take quick pay on every load. And so as that program increases, the amount of cash that's produced for the broker increases, because we are actually paying those carriers in 2 days and the broker's paying us at the end of their normal standard pay terms, which is 30 days.
What happens when that doesn't happen? I mean, we're talking a big issue here is risk, right? We're talking about risk on this show. And what happens when one of these participants can't pay their vendors, when cash gets tight, when cash gets hard? What is the impact on a broker?
So if they have a significant quick pay program and their liquidity is getting crunched, that program is likely going to be shelved. They just can't bear the burden of cash going out in 2 days and not getting paid for 45 to 60 days by the customer. We step into the middle of that and we allow that term to be put out to 30 days. We even offer supply chain financing that can extend that payable further than 30 days for creditworthy brokers to enable more cash generation for that broker. So it's really we have supply chain financing on both sides of the balance sheet. We can discount and pay invoices faster on the AR side, or we can extend payables, all for creating more cash.
Interesting. So tell me about the impact on the other end of that. What happens to their partners? Because this is all a cascading thing. You can't pay one person, the other person doesn't get paid, and this all goes wrong.
So, I mean, what our main goal in TriumphPay is to become the primary payor for carriers in the U.S. And our intent is to get them paid as fast and as quickly and as accurately as possible. One benefit of having this payments service now in place for over 4 years is that we have over 6 million distinct records from hundreds of brokers around who should be getting paid. And there's no one else with that kind of information to accurately get people paid, get them paid fast. And again, through the network, increase that or decrease that friction over time by having a fully verified, automated way.
Oh, hey, do we get his audio? I think I just lost Dan's audio for a second there. Dan, you still there? Guys, we still got Dan? Talk to me, Goose. Oh, Dan, did you accidentally mute yourself, perhaps? We lost your audio over there. We'd love to...
Are we back?
There we're back. We're back. Let's continue that conversation. How important is liquidity right now? You mentioned before money was cheap, right? So that meant there was a certain dynamic going on. Well, now money's not cheap. What does this mean?
It's going to be harder for especially small brokers unless they have some access to financing to scale, to grow. The market is already challenging enough, as we've seen kind of the boom in 21, 22 and the shifting trends within the freight market. When you add a liquidity increase or interest increase over time, and it becomes more difficult to access liquidity for growing brokers and startup brokers and carriers for that matter, they are needing partners like what TriumphPay and Triumph can offer to provide that cash in order to grow a business and sustain a business and not get eaten up by the interest crunch and not get into a position of liquidity where they can't make their payments.
How challenging does credit become in an environment like this?
It's certainly the underwriting process and the credit process gets tighter in an environment like this. We have history with a lot of these carriers and brokers, and we have a very mature credit and underwriting process that we are heavily involved with, and we make decisions based on relationship plus our review of the ratios and the financial condition of all these parties. So we will actively work with carriers, with brokers to understand where they are and to help provide the type of financing they need to weather some of these more challenging liquidity markets.
So if I'm a carrier, from your perspective, what should I be doing right now? What should I be looking at? What should I be thinking about in terms of factoring and what TriumphPay does?
The best way, for carriers to interact is, to make sure that they have the liquidity needed from either a discounted invoice arrangement, a factoring arrangement, or to work with reliable shippers and brokers that are going to pay them consistently in a timely manner. Carriers that are involved with brokers that are TriumphPay customers, they can see all of their payments that are coming through all the brokers that they work for that are TriumphPay customers. There is just an ability to manage how brokers are paying them, what their payment terms are, how fast they want to be paid by those brokers, at what discount. And so it's a cash, as you know, in small businesses, especially in the small carrier market, cash is king, and they have to get access to that to be able to continue to operate those units and get the next load. So we step into that in a couple different ways here at Triumph.
So how about the brokers? What should the brokers be thinking about? I mean, similar, but the reverse?
Yeah, I mean, the brokers, depending, scale is such a big piece of a brokerage's cash position. So these last 2 years, as people scaled, it put pressure on cash because of that dynamic of when customers are getting paid. Now that things have have slowed a bit. Just the ability to sustain through these more challenging cycles. You need to have options for financing and doing it through the supply chain, doing it through your carrier payables, your shipper receivables, and extending those in one manner, factoring or extended payment terms, can create that access to liquidity that will carry you through until you start to get the increased revenue and cash from a more robust market.
Interesting. So before we let you go, what should people be thinking about? Anything new coming out of TriumphPay? What is the first next thing they should do after they hear what you had to say here?
So, I mean, our biggest move is this network concept whereby we are automating the full presentment, audit, payment, cash application of carrier invoices through a structured data network whereby we know both parties and we know that the load is the load and who's getting paid is who's getting paid, and it can move through the network in a fully automated fashion. That is a growing and great piece of our business, which will save the industry money. It reduces friction for all parties in a significant way. So we are really moving that payments network forward. We are also going to be stepping into, as these times get more tough, there are unfortunately more people out there that may be misrepresenting who they are and double brokering loads, or there may be just flat out bad actors that are seeking to get fraudulent payments. And with our history and with our volume of records and payment records, we're going to be helping the industry navigate through some of that challenge here in the coming months.
Oh, interesting. Hold on. Now my ears are perking up. Can you touch on that real quick? What is this double brokering service? I worked on that side of the industry, big problem, and it hasn't gotten any worse since I got out of that side of the industry because I hear people complaining about it all the time.
There will be more to come in that space. Uh-huh. We're not ready to come out with it. But we have the focus from a data perspective that we have matched records that we've been accumulating over the last 4 years, and we'll be using that to help us, the industry, understand who is who and who should be getting paid and who is moving what load and are they who they say they are. So it's a very important thing with the position in which we sit for us to be good stewards of that data and in the industry and help people kind of navigate those challenges.
All right, Dan. Well, thanks for getting our beak wet, and for everything else, I really appreciate it. Everyone go check out TriumphPay.com. Thanks for coming on the show. I appreciate your time.
You bet. Thank you.
All right, take care. All right, got one more guest here. It is Steve Kochan. He is the founder and CEO over at ComFreight and Haul Pay as well. I think he's coming in out of California. Is he over in Long Beach over there? Steve, where are you sitting today?
Hey, Timothy. Yeah, here in Long Beach, and we're getting some much-needed rain, depending where you're at. Some folks like it, some folks don't. But yeah, over here in Long Beach, California.
Is it flooding over there? I saw like there was a ton of snow. The snow melted. There's been nonstop rain. It's been like an El Nino type of event.
It does remind me of El Nino for sure. NorCal's getting a lot harder and central, so I'm pretty close to the beach, but no squalls are taking the house away yet, so can't complain.
Well, so when I was in college, I really wanted to get out to Southern California, so I did an internship out at a record label, and it was during El Nino. So it never rains out in LA except when I came out there. And I didn't rent a car because my my extended stay hotel was only a mile away, and it just rained every single day.
I still remember those floods. They're notorious, so yeah.
They were notorious. Well, tell me about this. You're the founder of the company. Before we even jump into anything over here, what's the elevator pitch on ComFreight? What y'all do?
Yeah, sure. So ComFreight's evolved. I actually started it back in 2013 as a project to build a better load board. And then in 2017 raised a little bit of money, and we pivoted the focus and I started building a team around it to focus on financial technology for the industry. Specifically, we started with factoring, digital factoring for carriers, just a better way to do digital factoring. We integrated it into our load board. And then launched a mobile app a free mobile app for carriers loads and to do that digital factoring. And we've then expanded into broker invoice factoring, and we've just recently expanded into payments as a service for brokers and even shippers who may not need factoring or may not need financing, but want to use all the benefits of our automated workflows and technology. So it's a comprehensive financial technology platform for all three actors now. And we add in the free software like the load board and integrations to TMS systems to really up the value without increasing the price to the client.
When did you realize that you had to make that pivot? A lot of times with startups, it can be a near-death experience. Sometimes it's just good business. Sometimes your customers just pull you in that direction. That's the way the current is going. That's what they're demanding.
Yeah. So I think that I just started talking to our customers, frankly. So the load board had been I was trying to build this all-encompassing agnostic marketplace, which a lot of different startups I think have tried over the years, even since I decided to pivot our focus primarily. But basically just talk to our customers, say, hey, what's the next biggest challenge you guys have? I didn't think it was going to be really a good idea to try to go up against DATs or the truck stops, the roll and load board thing, and saw this as a bigger opportunity. It just wasn't getting addressed by the market yet. We've seen more obvious entrants now. I'm really excited you guys have this whole segment and symposium on FinTech and supply chain. But we were a little bit earlier and definitely seen some of the benefits for us and the clients now.
What is the biggest challenge that your clients are telling you right now? And has that changed? Has that changed over what we saw in the past couple of years?
As we all know, the industry goes through cycles. This is definitely one of the most challenging cycles for sure. I actually started my career back at the day at C.H. Robinson in 2008. So I've been through all kinds of interesting cycles and have been touching transportation in one form or another since then. I think the bigger challenges right now, and TriumphPay just mentioned it previously too, is you're going to have an increased risk of fraud, which is something that we also do currently address with the technology on the payment side, double brokering potentially. You're also going to have challenges in cash flow and credit terms, right? You're going to start seeing shippers and even some brokers want to extend their payment terms out. So being able to be dynamic in the way you price financing solutions and offer those solutions and even mitigate the risk, like we're completely non-recourse, which is kind of unheard of in transportation, especially in broker factoring. That gives a lot of protection to the client in an environment that might be a little tumultuous, to say the least, on the credit side.
Why is that almost unheard of, and why is that your approach?
Well, I'm a big believer in using technology to create a better experience that is better for the end customer, right? Just because maybe financial services have been done this way for 20, 30, 40, 50 years, especially as we see technology exponentially improving every year. I think I believe, and our team has this, belief that we can leverage that to create a more equal environment, a fairer environment for the small businesses and mid-sized companies, which is mostly what we target, and provide them with financing options that are effectively debt-free. Don't put them at risk from like a default. If like one or two invoices doesn't get paid, with most traditional factoring or financing arrangements, they get charged that back. And in the environment we're in now with rates and margins getting chopped down, or hopefully we're hitting a bottom, you may not survive that as a smaller mid-sized carrier or brokerage, right? So we do really leverage our technology to enable us to do things like that. Really proud of that.
So let's dive deeper on that. What are some alternative ways to finance your transportation business, especially from the perspective of debt or limiting debt?
Yeah, so when you do non-recourse factoring, you got to look very carefully at the terms of those agreements. And there are some very good companies out there in the factoring and transportation finance space that are a little bit more seasoned or just been around for a while. So but whether you're looking at us or one of the larger incumbents that does transportation factoring, pay attention to the security agreement, pay attention to the terms of what they have rights to as collateral. Are you signing away rights or personally guaranteeing this with your house, right? Are you putting up just assets in your business, right? That's going to be in the security agreement, a component of any of these factoring arrangements. Be careful with things like MCA loans or short-term business loans. Oftentimes the interest rates are extremely high and the terms are very unforgiving. Like if you miss a payment, they can come after all of your assets. They can come after even your personal assets. So really read the fine print when you're looking at alternative financing solutions, maybe that would be different than a traditional bank loan. In light of some of the things that just recently happened with SBV, for example, the bank that we saw in Signature Bank over this past few days, it's likely that banking regulations and oversight will increase. That means a lot of small and even regional banks may pull back in their lending. So you may be forced to look at some alternative financing options like factoring, like other trade finance, like accounts payable or receivable financing of other forms. So just really pay attention to that security agreement and make sure you're comfortable with the rights you're giving over to lien on your collateral, whether it be personal or business. That's going to be really important in the future.
Do we see, so now you got me curious, do we see predatory lending go up when money is free because it's easy and there's so much going on, it's easy to commit the fraud, or do we do it when people are desperate? Is now the time you really got to look out for it?
Yeah, well, depending on where you're at, I think that when when there's a lot of cheap cash, when the interest rates are really low, you do have a buildup of a lot of what they call like the shadow banking industry, right? Like smaller alternative finance companies, lenders, broker dealers, layers on layers of different types of finance brokers, and that can get quite convoluted. And there is an opportunity, or there could be there's sometimes more likely cases of onerous terms, or just regulators can't keep up with the volume of those type of operations going on. So I do think that's maybe a little bit more common, and we're coming through a cycle now where a lot of that's going to get kind of sunlight on it, so to speak. The market's just going to kind of force some of that out. And there'll probably be some consolidation in like the alt financing space, which does service a lot of our industry, right? I see more payment fraud and spoofing or pretending to be a carrier to kind of pick up a payment. Those type of things, chameleon operations in our industry becoming more of, I think, a tactical risk and a day-to-day risk. If you're operating, say, a brokerage or even a carrier operation that we have multiple owner operators or drivers. So making sure that you can trust who you're paying downstream, that's going to be more of a concern, I'd say, than an increase in onerous or payday lending kind of scenarios.
Oh, I hear you. By the way, Barack Ben Orr says, very interesting conversations. Can you please share the rest of the agenda for today? Absolutely. If you're on live.freightwaves.com, just scroll down. The agenda is right under you. Okay, fraud, double brokering, those kind of things. You get any tips for mitigating that? Constant thorn in the side of the industry, and it goes on every single day.
Yeah, I mean, it's really, we use tools, and I'm sure a lot of brokers that have either been bitten or gotten close to it, have kind of worked on getting tools arranged to try to help with that. So we use a basket of different services and data technology to help us, basically early warning when we're vetting, adding, let's say, carriers into our payment network, right? TriumphPay was mentioning they're working on something similar to that, for example. When we vet any kind of client, right? As we vet clients, as we add more carriers and broker clients, we're also doing a vetting process using that third-party data, and they have to meet certain standards to even be able to operate on the platform, right? So we're always trying to maintain a high degree of trust and fidelity in that network, whether or someone we're paying downstream, a factoring company, a driver, a carrier.
What should their clients look out for in terms of fraud? What are the signs and the risks there?
But I'm cutting out. Sorry.
Oh, it's all good. What should your clients? What should the carriers, the brokers be looking out for in terms of fraud? What are some standout things that they can protect themselves with?
Yeah, I think you want to be careful. Make sure your KYC is really the fundamental, right? So know who you're paying, know who you're booking freight with. Leverage things like Carrier 411 or other industry resources. There's a bunch out there. Watchdog, I think, is another one that TIA offers it. Get as many of those in your basket as possible and verify their information, right? If someone's saying, hey, pay me, or you're getting them set up for a payment, try to find out if they actually own the bank account, right? Do some legwork there. Make sure you're actually paying that company owner. Verify directly with the data that's on the FMCSA, right? That's the stuff I think would help mitigate payment fraud, and that's stuff that you can add to your process if you're not using a third-party service, tomorrow, so to speak.
Yeah, don't just wire money via Western Union to, like a random person.
And it's crazy because a lot of folks will say, hey, fill out our carrier packet, and, that's it, right? So
In global trade, it's even worse because it's much more plausible that someone in some of these foreign zones you'd be buying something from would have limited technology. They might be trying to contact you this way. So the fraud gets a little bit tougher. But the other thing that happens in freight are payment errors because, we get in this business, you get your billing quote and it's not the same. Then accessorials come on and something happens and something changes. It's a business where you really should be auditing your bills because they change frequently. But how do you protect against some of these payment errors?
Yeah, so getting data, like having some kind of data standard for your organization, right? So, if you take a step back and examine your process for your invoices, right? Are you just paying every invoice, without actually reviewing them through any process? Are there technologies or services? I've heard some really interesting ones today, and kind of listening in throughout the summit, that you might be able to leverage to kind of automate some more of that. So you're not losing. Some cases, groups are losing 5 to 10% of their revenue to just basic errors, right? How is your TMS or whatever technology you're using to manage your load data talking to your financial platform, right? Is there some kind of connection there where the structured data can get passed there without being disturbed, and this kind of continuous flow from like what is the source of truth that was agreed to during the tender, all the way down to the final invoice, and then is there a way for you to verify that, right? In your smaller, you can start implementing processes that are manual, and you can do that right away. But as you start to get larger, and hopefully all the businesses listening will grow and survive and thrive through this cycle, you'll want to find ways to automate that, and that's something that we can help with. And again, there's also some great resources out there too that we've heard about today.
Now, beyond paying people because it makes them happy and it keeps your services active, one of the main reasons you want services like this is to limit the amount of touch points you have, right? To automate a lot of this, to just make this process easier and less of a headache. How do you limit some of the back office expenses to stay leaner, and how does this help with that?
Yeah, so kind of playing and building off what I was just mentioning about having structured data and getting that data to be continuously passed along different pieces of your tech stack, basically, right? Just that alone is going to make it less expensive for you to scale over time, right? You may not, like some of our largest clients that have grown with us for the last several years now, especially on the broker factoring and payments piece, they'll come out, they'll reach out to us, be like, hey, if we weren't with you guys, we'd probably have 3 or 4 times the number of back office staff than we need to have today to have gotten to this pretty rapid growth rate, right? So it can limit your growth. It can limit your ability to scale when you've got a manual process where there can be things that break down. It may not be fully consistent. You have to train new people up, and if you have a big client walk in the door and you get a big surge, then you may have to expect that for a certain number of months till you get that next person, and you're going to have a higher level of errors and loss in your business, right? So that's things that, when I was a broker, I didn't really think about that much. And once I got more involved with the back office and developing technology, we realized it's such a big challenge. So definitely ways that you can limit that, again, leveraging technology, living solutions like Haul Pay. There may be other ones out there as well. To just get a better multiple out of that back office. Because I do believe that technology should be, kind of supercharging and helping support our businesses rather than trying to eliminate positions outright. But if you can have 1 or 2 people instead of having, 6 or 7 or 8 or 9, that's significant cost savings to the business. It'll limit the amount of errors because that, hopefully the digital tech stack is communicating that data through. With lossless error, with no errors, and you'll be able to scale faster, and it just all kind of fits together for a better overall back office.
Well, before I let you go, SVB was a reminder that risk can come at you really fast. Anything else on the horizon that we should be looking out for here that may trip us up in 23?
Well, I think fundamentally the banking sector is good. I mean, without getting into politics, they backstopped SVB, and that's going to keep a lot of businesses operating and a lot of cash, and especially payroll, so especially this week, and a lot of venture companies that were backing a lot of newer entrants moving. So, I don't think there's a systemic risk in the banking system. I think we'll still definitely see some headwinds in the credit market, like I mentioned earlier. banks will probably see some more increased regulation, even without new policy being passed this year. And that may mean that they're going to tone down the amount of small business lending that they're doing. This happened after '08. This is not anywhere near '08 or like financial crisis from a macro, in my opinion. But I think you may see tightening on small business or even mid-market lending. So you may, as a business owner in transportation, if you're looking for financing and just working capital in general, be forced to examine more alternative financing or trade finance options. So again, read those security agreements, figure out what they're going to put a lien on. I really try to understand those as much as you can. And if you have to pay a lawyer a couple hours, and it'll save you a lot in the long run.
Steve, thank you so much for your time. Everybody go check out ComFreight. Take care. Have a good day.
Thanks, man. Take care.
See you later. Thank you to Triumph Pay for sponsoring this episode and all of our guests on the show today. Hey, stick around. We got a couple more sessions after our networking lunch break. We got a fireside chat on uncovering the insurance crisis with Johnny McCord from Loadsure and the great Grace Shockey from FreightWaves. We got payment prioritization depends on capacity constraints with Haley Nix and Jake Detmer from Max Services. And we got how the supply chain and FinTech converge in Latin America with Tommy Watson and Jamie Hebchenek from Solvento. Find me on Twitter at Timothy Dooner if you like this show. Subscribe to it wherever you get podcasts. Look up What the Truck or go to FreightWaves YouTube channel. Subscribe over there. Find me on Twitter at Timothy Dooner. Take care. Don't be a stranger and enjoy lunch.